Welcome to The Explainer. Today we're tackling a fundamental concept in business accounting that affects pretty much every company with a physical product. We're talking about inventory. It's the lifeblood of their business, but how on earth do they put a value on it?
I mean, think about it. How does a company look at an entire warehouse just packed with stuff and put one single number on it for their financial reports? It might sound simple, but the answer has a massive impact on a company's financial health, influencing everything from their reported profits to how solid they look on paper.
The answer, at least here in India, is governed by one key set of rules, Accounting Standard 2, or AS2 for short. It's the playbook that ensures everyone values their inventory in a consistent and, really importantly, realistic way. Okay, let's dive in and break down how it all works. All right, first things first. Before we can figure out how to value inventory, we need to be crystal clear on what the standard actually considers to be inventory. So the standard breaks it down into three main buckets. And it's not just the finished product sitting on the shelf. It's the entire journey. It covers the raw materials you start with, the stuff that's currently being made, all the way to the final goods that are ready to head out the door. Let's make this super simple. Think of a bakery. You've got your raw materials. That's the flour, sugar, and eggs sitting in the storeroom. Then you have your work in progress. That's the dough being mixed and kneaded. And finally, you have your finished goods. Those delicious, freshly baked loaves of bread all ready to be sold. All of that, from the flour to the loaf, is inventory. Okay, so we know what inventory is, but how do we put that single value on it? Well, AS2 gives us one golden rule. That's the foundation for everything else. And here it is. If you only remember one thing from this whole explainer, make it this. Inventory must be valued at the lower of two numbers: what it costs the company to get it, or its net realizable value, what they can realistically sell it for. Whichever's lower, that's the number that goes on the books.
Now, the whole idea here is a principle called prudence. It's all about being conservative and making sure companies don't make themselves look healthier than they actually are by overstating what their assets are worth. So to apply this rule, we've got to understand both sides of the coin, cost and net realizable value.
Let's start with the first piece of that puzzle, cost. And you might think, oh, cost is just the price on the invoice. But believe me, it's way more comprehensive than that. AS2 tells us to think of cost as being built from three key layers. First, you've got the costs of purchase, the price you paid plus any taxes or shipping to get it to your factory. Then, costs of conversion. That's the labor and factory overhead needed to turn raw materials into a product. And finally, any other costs that were necessary to get the inventory to where it is and in its current condition. Now, what's really fascinating here is the discipline this forces on a company. It draws a very clear line in the sand between what's a product cost versus what's just a general business expense. So, for example, the cost of shipping materials to your factory, that's in. But the cost of advertising the final product to customers? Nope, that's out. That gets expensed right away.
Okay, let's flip to the other side of our golden rule. What happens when the value of your inventory drops? Maybe it's obsolete, maybe prices have fallen. This is where net realizable value, or NRV, becomes absolutely critical.
In simple terms, NRV is just the net cash you expect to walk away with after selling something. Think of it like this. It's the selling price minus any more money you have to spend to finish the product and to actually, make the sale happen. Let's look at a quick example to make this concrete. Say a company has a half-finished product. They figure they can sell the final version for 250 rupees. Great. But it's going to cost them another 100 rupees to finish it, plus 10 rupees in sales commissions. You subtract those future costs, and the net realizable value right now is 140 rupees. And right there, that's the golden rule in action. The company has already spent 150 rupees on this thing. That's its cost. But its NRV is only 140. And because 140 is lower than 150, the company must reduce or write down the value of that inventory on its books to 140.
Okay, so that all makes sense for one specific item. But what about a huge company with thousands of identical products, all bought at slightly different prices over the year? How do they track the specific cost of what's left in the warehouse?
Well, the short answer is they don't. It would be impossible. Instead, AS2 lets them use a cost formula, which is basically an assumption. The two big ones are FIFO, first in, first out, which assumes you sell your oldest stuff first. The other is weighted average, which kind of smooths out all the price changes. And believe me, the choice between them can have a real impact on a company's profit. So after all this technical detail, we have to ask, why does this one number matter so much?
Why should an investor or a business owner care? Because the value of inventory tells a powerful, powerful story on a company's financial statements.
And look, this isn't just some theory from a textbook. This is the real deal. Here's a direct quote from the accounting policies of a major company, Asian Paints. They state this exact rule, word for word, in their annual report. It's central to how they operate.
And companies can't just throw a number out there. AS2 makes them be transparent about it. They have to tell you what method they're using, like FIFO or weighted average, and they have to give you a breakdown of the total value into those categories we talked about: raw materials, work in progress, and finished goods.
And here's what that actually looks like in their report. You can see the real numbers. Over 700 crores in raw materials, almost 96 crores being worked on, and over 1,000 crores in finished goods just waiting to be sold. This gives you incredible insight into their entire production cycle.
And remember those write-downs we discussed? They have a real financial impact. In just 1 year, Asian Paints had to recognize an expense of over 14 crore rupees. Why? Because the net realizable value of some of their stock fell below its cost. That's the golden rule directly hitting their bottom line.
So, the next time you're looking at a company's balance sheet and you see that line item for inventories, I want you to remember it's so much more than just a number. It's a story. A story about a company's products, its efficiency, and its ability to compete in the real world. And thanks to AS2, it's a story that's told with discipline and a healthy dose of realism.